All right, everyone, good morning. It's 9 o'clock and I want to stay on schedule because after us is a little break before some more general sessions. So, good morning, everyone. I'm Amanda Smith and I'm an extension economist here in Tifton. And I want to talk to you today about what's going on as far as inputs and how that's going to affect cotton. And then if we have time, I want to show you some changes that we've made to the cotton budgets and also look over the comparison of net returns and crop costs. So let's go ahead and get started. And so one of the big things that I like to do to start my presentation is talk about the economic environment going into 2020 because everything is related on a global scale. As far as growth of the global economy, it's expected to slow down. Last year it was like 3.2% and IMF is projecting 3.5%. A lot of that slowdown is because of large consumers of products are slowing their growth as well, the United States and China. And what we're seeing, maybe not the numbers so much are as important, but the trend is that there's a slowdown in growth. And that matters a lot for cotton because when the economy is not doing as well, we're not going to be replacing our clothes as frequently, linens, and so on. Also, it definitely affects the demand for the inputs that I'm going to be talking about as well. We continue to see uncertainty with the EU and Brexit, what's going to happen as a result of that. And we also see trade friction with sanctions and uncertainty as far as what's going to happen as far as the trade agreements. And of course now with the coronavirus, you know, China has proposed to buy a bunch of food products, but right now they need to focus on dealing with this virus instead of focusing as much on trying to get this trade deal into play. Of course, everyone's aware of the tension in the Middle East, and that's going to affect energy markets. As far as interest rates are concerned, another important input for us is credit. The Fed did lower interest rates after several years of gradually increasing interest rates. In 2019, they lowered them a couple times. As of December, they expected to keep them stable, and they're meeting again today. So we'll see what happens if they decide to keep them stable, lower, or up. And of course, agricultural production is still bountiful across the board. At the end of last year, I read a really good article, and this was from Jason Henderson, who is the Dean of Extension at Purdue University, and he used to be a former Federal Reserve economist. And we used to have him come speak at our Southern Ag Outlook conference to give us kind of a macro picture of what's happening in agriculture. And I really liked his article. He was talking about, you know, we're not so much concerned about the financial crisis that we saw in the 80s. That's probably not going to happen again because we learned a lot from that. Banks and lenders learned a lot from that. We're not seeing interest rates going high like we saw back then. But what is likely to happen is a plateau period. And we've seen two plateau periods since World War II. One was in the late 50s and the other one was right after the financial crisis that we saw in the late 80s. And what happens during a plateau period is we see prices hovering around the average cost of production. So we're not going to see really big profits, potentially maybe not some really big losses. And since farm incomes are flat, farmers tend to rely more on government payments during those time periods. And we saw that last year, or we've seen that just recently with the market facilitation program. And the question is, will that continue? Also during plateau periods, we see more consolidation as those farmers who are profitable take advantage of opportunities out there that of those farmers that are not seeing the profits and are stepping out. Also, farmers tend to diversify more and look at alternative enterprises to figure out how can we make money and make profits. So I think that was a really good article to really kind of start off 2020, and I wanted to share that with you guys today. All right, so what happened last year in 2019? Really, as far as the inputs were concerned, in general, we saw them go down. Of course, labor went up, taxes and feed went up, but fertilizer, seed, interest, all of that went down in 2019, including fuel prices. So that was helpful to the margins and the profits. All right, so land is another very important input, of course, and in Georgia, we actually saw farmland real estate values go down compared to 2018. So they went down a little bit in 2019. Talking to some growers, their feeling is that, I'm not seeing highly productive land going down in value, but maybe that's more a result of less productive land, going down in value, or maybe going out of agriculture into something else. All right, so what's happening with cash rents? These are cash rents on irrigated cropland in the southeast, and the solid gray line, or the really thick gray line, to kind of make it stand out a little bit. I should maybe change that color, but it's bold. That's Georgia, and we're looking from 2012 through 2019. In general, the trend is for those to go up. And hearing other producers, they are seeing that as well. The question that I got at one grower meeting was, and I don't know the for sure answer to this, but are landowners seeing these market facilitation program payments coming out and wanting to capture a little bit of that? And the likelihood of that is probably a yes. So cash rents, we're seeing those go up. All right, so land is very important, mainly because it's excellent collateral. So what's happening as far as the lending situation? These are results from the American Bankers Association, or the Ag Bankers survey, asking ag lenders what they are most concerned about coming into the future. And the number one thing that they're concerned about is liquidity and the level of farm income. All right, so liquidity is the ability to pay current debt. All right, so what do you have as far as cash, inventories, things on hand that you can sell within a year to pay any debt that is due within a year? And they're seeing that liquidity or working capital going down, and so they're concerned about that. You know, are we having to extend operating notes longer than a year just to get us by? Also, they're concerned about farm level incomes. Of course, they went up, but that was because of the government support from the market facilitation program. So will programs like that continue into the future? Okay. Everyone has heard about the conflict in the Middle East. Of course, we had the oil attack in Saudi Arabia. That was maybe a $20,000 drone, you know, not very expensive, but it caused a lot of damage. 6% of global supplies were affected because of that cheap drone. So there's a lot of political implications at play. Also heard about the recent assassination of General Qasem Soleimani in Iran, and that caused some disruption as well. So what we're likely to see as a result of this is increased volatility in fuels. Maybe eventually that'll affect fertilizers. Fertilizers are not as highly correlated to fuels as they were, 15 years ago, but eventually that will affect them down the line. All right, so as far as diesel fuel prices, we are expecting them to go up just a little bit in 2020. I've got them at $2.50 a gallon in the budgets. Last year we saw probably $2.35, $2.40 for farm diesel prices. So up a little bit, but definitely we're going to keep an eye on that and see how the volatility is affected, those prices. All right, so I want to move on into fertilizers. So nitrogen fertilizers, we saw all nitrogen, phosphorus, and potassium all lowering in price. Right now, about 11.5% from last year, we're seeing those prices, 11.5%. So that's definitely going to help from a cost standpoint, is lower fertilizer prices. Just so you can see, for 32, we're looking at it right between 2018 and 2019, and 9.5% less than the 5-year average for that. Phosphorus, we're looking at 11.2% below the 5-year average right now. And potassium, that one hasn't dropped as much, and it was a little slower to drop. So we're seeing only a difference of 2.5% from the 5-year average of potassium. A little bit less than 2019, but really not that different. So what we have in the budgets, we have 50 cents for nitrogen, 40 cents for phosphorus, and 35 cents for potassium. I'll look at the crop comparison tool and confirm that for sure. Those we're anticipating an increase in demand prior to planting season. But based on the supply and demand fundamentals of fertilizers right now, they're not really expecting that much of an increase. So the prices that I have in the budgets might be a little conservative. So if you're a grower and you're looking at trying to estimate what your cost of production is, adjust those prices in the budget to reflect what you're actually paying for those inputs. Mine might be a little bit high. All right, so the overall outlook, land values probably going to increase or stay steady. We might see them go down as far as the less productive lands. Cash rents are likely to increase. Interest rates are down and expected stable. Going to see more volatility in fuels. Fertilizers are down, so that is one of the bright spots for us to see. Seed prices were up slightly. Ag chemicals mix, that's the same story every year. Some go up, some go down. And then we're seeing machinery and labor up. All right, so I want to take a couple minutes and just show you. We have changed the format of the cotton budgets from what you have seen in the past. And we wanted to do this to add some functionality in there that you can change the seed technology and also the harvest equipment. All right, so the way to find our budgets is you can always go to agecon.uga.edu/extension and then click on budgets, or easy way to remember is Google UGA cotton budgets and see if they'll pop up that way, and then you can download them.
Amanda, are they PDFs or are they Excel?
They're an Excel spreadsheet version, so you can change the numbers in there. So if you're putting out a different amount of fertilizer, because our budgets are actually for 1,200 pound cotton, and several farmers like to plant for 3 bale, and so you will need to adjust the fertilizer, the nutrient requirements for that. And it's a really handy spreadsheet decision aid, or maybe not decision aid, but kind of get you a general idea of what's happening with net returns and crop costs. So we'll have the budget side by side, and I'm going to see if I can turn the computer on so you'll be able to present. So it'll give you a comparison of what's happening as far as potential net returns. So we look at the prices of cotton, and it's harvest time futures adjusted for basis, and except for the case of peanuts, where that's where we think peanut contracts are going to be.
We can go to my laptop and boot it off of it.
I do. Let's see, where's my computer? Oh, my computer's in the way back. Yeah, so anyway, what we're looking at for irrigated, the numbers are more attractive for cotton, corn, and peanuts for under irrigated production. And dry land, it really is more leaning towards more peanuts. All right, so the cool thing about this is you can change the seed technology.
Go to full screen up here. There we go. Nice.
So sorry about all of this, you guys. All right, you can change it so if you're using Roundup Flex or Extend Flex, you can change that. You can also, let me zoom in for you a little bit so it's a little easier to see. Also, you can change the harvest equipment. So if you're using a round module picker or a basket picker, you can change that. And it will adjust your fuel, repairs and maintenance costs, and things like that based on the equipment that you're using. So let me show you the crop comparison tool. So again, you can change those yields. So if you want to adjust, and this one we've already got it embedded in there. So if you're to plant to 3 bale cotton, it automatically adjusted that fertilizer price. Maybe your corn's going to be 220 bushels, peanut yield, comparable. 5,000 pounds. So let's look at and see how they compare from an irrigated standpoint. And what you're wanting to look at when making your planting decision is this yellow row, your return above your variable cost, because that's what it costs to plant, grow, harvest, and market your crop. All right, so we'll figure out how to rig that for Dr. Robinson's presentation. But there you can make the comparisons. All right, so you want to look at your return above, what it costs to plant, grow, and harvest the crop, and what's going to generate the most. Now keep in mind we don't have land rent in there, and last year the state average was $208 an acre for irrigated cropland. So if you're looking at deciding what to plant, keeping in mind crop rotation, on a rented acre, plug in that $208 and see what it returns. Also, take a look at the break-even price and say, all right, so then you look, all right, so we plugged in that $208 land rent, break-even price now for cotton is 55 cents a pound. And everything above that is what is going to pay you as the manager, paying any debt obligations, maybe any family living withdrawals, and things like that. Any questions or comments despite the technical difficulties? Okay, I want to make sure we have enough time for Dr. John Robinson. He's visiting from Texas A&M, and he's going to give us the cotton outlook.
Now I'm a little scared. Well, Amanda and Serena and the University of Georgia were nice enough to invite me over here, and I suppose, being the outsider now, I can say what I think and be controversial and do whatever. It's a good situation to ask questions, so if we got time, please feel free to do that. I've got some background that is that to advance? I can drive and wiggle that. All right. I'm going to skip through a little bit of the background because I don't need to really cover it too much. Keyboard assistant. I want to do those things. But think back to last year. There's been a lot of fluctuations in the market, more than usual, I would say. If you think back to the first half of 2019, we were anticipating a big crop. We had a lot of moisture in the southwest. You want me to talk louder? Okay. I will talk louder.
I think there's a handle up there that's actually just for vehicles.
Oh, okay. Okay. Well, hello. Testing, no. There we go, testing.
Should work now.
Testing, testing, there we go. So think back to the middle or first half of last year. The situation was we had a decent amount of acreage planted. We had a lot of moisture. We had expectations of a big crop. People were thinking 22, 23 million acre crop coming. That was one thing that started to weigh on the market. The other was this China tariff thing, which has been going on and on and on. We thought, well, that's going to hurt demand, and we have a big supply coming, so the market's probably going to go down, and either because or in spite of our predictions, the market went down first half of the year. If you remember, the futures market slid to as low as 57, something like that. So that was in the first half of the year, and then it kind of reversed. We've had a kind of a big switch. First of all, USDA in the fall was trimming their guesstimate of how big the crop size was. It went from a 22 million bale crop to around a 20 million bale crop. They cut a lot of production out of Texas, out of the Southwest, where yields were low. They had a slow, cold, wet start, a dry summer, and an early freeze, and that really did a number on the West Texas, Northwest Texas acreage, and Kansas and Oklahoma, where cotton's been expanding. So a lot less production than we thought, and a little bit of resolution, or at least hopefulness about a resolution to this China tariff thing. And that helped change the bottom line to raise old crop prices. I'm going to skip through some of this stuff and get us right to here. So USDA's cutting the production estimate, again, we were worried about this is what an economist worries about. I wish this on every farmer in the world, but we were worrying about a big crop, big strong yields, 22, 23 million bales. And if that was to have happened, this bottom line number, the ending stocks number, would have been huge. They were forecasting over 7 million bales of ending stocks back in September. Well, they cut production. I can talk until it comes back on. They cut production in the October estimate, and the ending stocks went to 7, and then it went to 6, and then it went to 5.5, and now it's currently sitting at 5.4. Now those are big adjustments, and they really change the implication of what kind of a year it is and how tight it is. And so it's kind of moved us to where, compared to the previous years, we're really kind of in the same ballpark as previous years of ending stocks. We're treading water. That's why the futures market went marching back from 60 and spent a lot of time range bound in the mid 60s and up into the upper 60s, and lastly in December finally made it over 70 cents, and now lately we've been hovering 69, 70, and I haven't looked this morning, I was driving, but I assume we're still up there. So this is a big change, okay? And it's brought about because of the change in this ending stocks as USDA trimmed the crop. Okay, so that's kind of the old crop situation. Let me touch a minute on some of the demand indicators, and fortunately Amanda has done a good job setting me up to talk about that. So to begin with, when we think about cotton, as Amanda's already pointed out, she made the point that this slide would tell you. This is periods of time. Those tan bars are recessions going back 30, 40 years. That blue line is per capita consumption of cotton in the world. That is to say 7 or 8 pounds. You can figure how many shirts that is. But that's how much cotton people consume. And the point of this slide is it goes down during tough times. That's not surprising. It's not rocket science. When times are tough, you're worried about your job, you're getting less money, you have fear or whatever, you still have to eat and you still have to put gas in your truck, but you don't have to go buy a new wardrobe or home furnishings, which is what we use cotton for. So it generally declines during those periods. So, and Amanda already stole my thunder on this one. All right, so what times are we in? And she already suggested IMF is forecasting we're in a period of low, slow growth, as opposed to like a boom time back in the 2000s or a great recession. Now, we did have a little uptick in the U.S. economy right after the election of the new administration. If you remember, the stock market went up, business confidence went up, they cut a lot of regulations, we passed a tax cut. That all contributed to that right there, and that's good. And that's good for cotton consumption. But it sort of has run its course. Perhaps because the tax cuts have done whatever they were going to do, and perhaps because we've got tariffs on a lot of stuff from a lot of places, and other people have tariffs on us. And what is a tariff, friends, except it's a tax on consumption? It just makes things more expensive, and it slows growth. And that's baked into some of these projections of flat, slow growth. So what this tells me from a cotton market standpoint is that the slow, steady upward pull from the demand side is really not there. It's really not there. So what's going to have more of an influence, I think, on the cotton market, particularly in the short run, particularly in 2020, what's going to have more of an influence are supply side questions, production questions, like acres and weather and abandonment and that sort of stuff. And you already know what kind of a weather market influence that is. It means things will be volatile. It won't be a nice, strong upward pull on the market. It'll be a lot of volatility around acreage reports and crop condition reports and things like that. So that's kind of the 30,000-foot view of cotton demand. Here's the close-in air-to-ground support view of cotton demand. Before we make it into towels and sheets, we export it, except in your world, where we still have a domestic cotton industry, but almost all of my Texas cotton is exported, and 80% of U.S. cotton is exported. So this is a picture of exports in blue, okay? So let's see, that's 365,000 bales exported that week, and that's 205,000 bales exported that week. You can see it fluctuates a lot, and it fluctuates in response to price. So here's that big price decline early in 2019. Well, that stimulated a lot of buying. When our cotton gets cheap, you know, the mills aren't dumb. They look around the market, look around the world, the suppliers, and they buy the cheapest. They buy the cotton they want for the cheapest price. So ours got really cheap, and we had a whole lot of export sales as a result of that. So that's good. Now, a lot less of that is going to China. We've lost market share over this period to China. Brazil's gained at our expense, but we're still shipping cotton to other people, and those export numbers are pretty decent, and the total number is pretty decent too. So I wouldn't look at that and say that there is a problem at all associated with the tariff situation with China. It's not in the numbers themselves, the total numbers. So we got large quantities supplied at lower prices. The reverse is also true. As the market has rebounded and come on back up, you can see kind of a slight downtrend in the export sales there. I'll wait for it to come back. So the real question, which I get a lot, is what's the impact of this China tariff phase 1 agreement to solve this tariff problem? And the answer is, well, we need to see some of this stuff in the wake of that phase 1 agreement. The most concrete thing that agreement did was basically say, we're not going to raise our tariffs on their stuff anymore, and their stuff includes all the apparel that they send us, and they're not going to raise tariffs anymore on the ag products that we sell to them. That was the most concrete thing. We're not going to make it any worse. Beyond that, they have this agreement to buy $32 billion worth of ag products, but over a 2-year period, and it doesn't break it down, at least not that we can read, break it down by which ag products. So we don't know if we're getting anything, we being cotton, are getting anything out of this phase 1 agreement until we start seeing these kinds of things happen. And I don't know if that's going to happen. I don't know if it's going to happen in the next 6 weeks or not, or 6 months, but we need to see strong new export sales to China to conclude anything about the phase 1 agreement being a good thing for cotton. And short of that happening, what I personally think is going to happen is what has been happening. The market, it rose. The last little leg over 70 cents was in response to the phase 1 agreement being announced in December and signed a couple of weeks ago. I think the market's probably going to look at this thing. If nothing happens and we don't have strong export sales to China, I think the market's probably going to say, hey, where's the beef? What are we going to get out of this thing? And we may retrench a little bit, retrace a little bit, go back into the upper 60s probably and hold, but I could see us stepping back until such time as we start seeing really good, strong export sales to China specifically, okay? That's all I want to say about that, and this chart just says basically the same thing as the last one does. The pace of export sales are strong, mostly to other people. All right, now I'm going to spend a little bit of time on this one because this one suggests to me what the pattern of price movements are going to be this year and how the opportunities are going to come at you. So what this actually is, I'm still talking about demand, but this is the demand in the futures market, so it's kind of pseudo demand because it's the influence of speculators in your markets, okay? In your cotton market specifically. These are futures contracts, cotton futures contracts, bought by 2 different types of speculators. The guys in blue are what I call index funds, and those are just big institutional, like big banks, investment banks. They have investors' money. They've got billions of dollars. They invest their investors' money in stocks, bonds, and commodities, very broadly, okay? So they're following some commodity index, but it's basically a formula. So they'll take $1 billion and they'll buy 40% of it. They'll buy oil and natural gas futures, precious metals, corn, and maybe 3% of it is they're buying cotton futures. Now that adds up to a bunch of cotton futures right there. That's 80,000 futures contracts. That's 8 million bales worth of cotton futures that are being bought by these guys who are not really thinking about agriculture. They're not thinking about cotton supply and demand. Their focus is on commodities real broadly, okay? And so they're probably an upward distortion in your market, all that buying. So you should be glad that they're around because that's a lot of volume that they're supplying When you want to sell short, when the merchants want to sell short to hedge their positions, these are the guys on the other sides of that trade, these guys in blue. It's a lot of volume, it's a lot of buying, it supports your prices. So send them a thank you card if you could identify them. Thus the guys in blue, the ones I really want to focus on are these guys in green, and I'm calling them hedge funds. And they're trend followers. Just think of them. They're also investment type people. They have client money. They're trying to get an extra return on usually their rich clients. And so they invest in commodities, and the way they do it is they try to guess the trend, and then they try to benefit from that trend. So if they think the market's going down, they'll sell, and the market will go down, and they'll buy it back at a low price. They're trying to make money on the trend. They use fancy computers that generate buy signals. They use charts and technical analysis. Some of them have teams of people that actually, travel around the country and try to get the edge of information to guess the trend. Now, they're not perfect, and some of them that I've talked to sound pretty crazy, but anyway, they're trend followers. So let me point you to an example of how they operate. That right there is 94-cent cotton. Do you remember that? April 2018, 94-cent futures. It coincides with a rather massive buildup of these guys, and this is the pattern. They'll get on, and I don't remember what was going on in April of 2018, but these guys, their opinion obviously was the market's going up and we're going to benefit from it, so they got in and bought. So they, in a self-fulfilling prophecy, they bought the market up into the 90s. I don't think it necessarily, I can't think of any economic reason why it should have gone into the 90s, but they gave it to you, for a few weeks, 1, 2, 3, or 4 weeks or so, and then they either changed their minds or took their profits or whatever, but as they got out of that long position, sold off those futures, the market came back down through the 80s, into the 70s, into the present range that it's traded. That's the kind of influence they have. And notice, when it comes back, notice that they do that a lot. For whatever reason, they'll buy it up, but those peaks are skinny, which is to say that they're a week or two long, okay? And they'll pull your market up, and you can't tell from these little red blips, but those are 3, 4, 5-cent rallies in the market that, again, are about a couple weeks long. And that's the influence that these guys kind of have. It can also happen to the downside. If you remember last summer, that's 57-cent cotton futures given to you by these guys selling. Their opinion was the market's going to go low. Now, I think I remember why they were doing that here. They were thinking there's moisture in West Texas, we're going to have a big crop, and China's hurting the demand. And so they got on the bandwagon to sell, and in a self-fulfilling sort of prophecy, they pulled the market lower, down to the lows below 60 cents. And then as they started to get out of that, because why? New information, USDA says the crop's really not that big, and the China trade thing may get resolved, and whatever. That kind of, they got out of that position, and as of about 4 weeks ago, they've built up a small net long one again. Just my opinion, but what I think the China Phase 1 agreement did concretely was, again, just because of the more concrete notion that things aren't going to get worse, that was probably enough to scare those speculative shorts back out of the market and push the market over. That they had to buy their way out. That buying put us over 70 cents. My opinion, that's probably the most that we are getting or have gotten out of the Phase 1 agreement is the elimination of that and the lift of the market over 70. But as I said before, until we see new, strong sales of U.S. cotton to China, I don't know that there's any more market effect to that Phase 1 agreement until we see the evidence of new exports. The last thing I want to say on this chart is forgetting the Phase 1 impacts, just thinking ahead to 2020. The market is, I think, and I'm going to make an argument for this, is going to have the opportunity to rally into the mid-70s, the futures market into the mid-70s, maybe the upper 70s. But it's going to be around supply and production kind of questions. Is this going to happen at least once in 2020, is that these guys in green are going to read the headlines about either low acres or bad growing conditions or whatever. They're going to get on a bandwagon, the crop is getting smaller bandwagon, and they're going to go on a buying spree. You're going to have one of these peaks. in that speculative buying. That's going to happen at least once, maybe more. But when it happens, that's when the market is going to shoot up to, let's say, I don't know, 76, 77, 78. That's going to happen. And so your marketing plan, whatever it is, needs to be quick enough to go in there, whatever, in a 1 week, 2 week period when prices are a nickel higher than they're going to be for the rest of the season, to go in and grab that. Either go in and sell futures against it, or buy put options against it, or call your merchant that you have a basis contract with and fix the price, or just contact a merchant and sell. Or even if your cotton is being sold by a pool, if they're not being aggressive in positioning in the market, then you could do that yourself. They're not mutually exclusive. However you market things, it has to be designed around fast, nimble opportunities, because that's the nature of those opportunities given to you by these guys, okay? And that's going to be true in 2020, I think. I'll skip that. The point I make with all this slide is just kind of the obvious, that you're in a global market and you got to worry about things on the other side of the world that don't have to do with agriculture, whether it's China or whatever you were just talking about, the virus, or Turkey shooting artillery shells at people in northern Syria. We got to worry about things that don't involve agriculture, but that's just the nature of the business. All right, so enough of that, and let me get on to the question of 2020. What's going to drive the 2020 market, I think, in the biggest way is how much we plant, and that guesstimate has been changing like nobody's business. So here's a simple tool that I use, basically predicting cotton acres based on relative prices to other stuff. Now, cotton competes obviously with corn, soybeans, peanuts, and other minor crops. This is just looking at it from the standpoint of corn prices to cotton prices. But the relationship historically is pretty good. This is planted acres. These are acres planted in 19 and 18 and 17. And the relationship just to corn prices is pretty strong. So I'm guessing, somehow peanuts and soybeans and all that is captured in the corn price. So what you got over here, just to make the math easy, think $7 corn divided by 70-cent cotton. What is that? That's 10. On this scale, that would be a 10, way over here. And if we had $7 corn, you'd probably have less than 8 million acres planted. It'd all be in Texas probably. But we don't have $7 corn. We got $4 corn off and on. I'm talking the December 20 corn futures, CBOT corn futures, divided by ICE cotton. If you do that ratio 5 months ago, back in September, the ratio was 6.5, back when we had $4 corn and 62-cent cotton futures. And that would give you, historically on this trend line, that would put you around in here, somewhere around 10.5 million planted. And honestly, that's what I thought. That's what I wrote in the Farm Press. That's what I said in my fall presentations. And it's wrong as heck because, well, it's out of date. It's updated with new information. So this was September. In October, the price of cotton went up a little bit. The ratio is a little bit smaller. That would put us here on the trend line, planting around 11 million plus or minus a million acres. That's in October. In November, December, the price of cotton's going up. Price of cotton actually dropped a little bit. That would put us planting around 12. And that happens to coincide with the first survey that is put out by Cotton Grower. They do the survey in the same time period, November, December. And so they were projecting 12 million acres planted. They released that at Beltwide, and then it was promptly out of date because, if you look more recently, as of the 10th or so, higher, and that's gone down a little bit. But that ratio is over here somewhere, and it puts us planting around plus or minus 13 million acres, which is in the range of last year's planting. So, gee, that doesn't give me much confidence as an analyst to pick an acreage number. So I'll just tell you what I think. What I think is going to happen by planting time, again, is that cotton prices will probably retreat a little bit. At least I wouldn't be surprised if that was to happen. Cotton prices retreat a little bit, and my corn marketing friend thinks that corn futures are going higher because they've harvested a whole bunch of wet corn that's going to be shrinking physically and statistically. Those corn stalks are going to get smaller. That doesn't usually happen this time of the year, so he thinks the corn market's going to react to it by a little rally, which may pull up new crop prices. So if that goes up and that shrinks a little bit, that may put us back in the realm of planting 12. And I'm just going to go with 12 because I have to have a balance sheet to talk about my market outlook. So, and it is dry. Let me say something about dryness. In Texas, when it's dry, we plant more cotton. We do that agronomically, it does better than grains. We do that for insurance purposes, it pencils out better than grains. So if you're going to not harvest anything, or if you're just going to have scraggly plants out there, you're better off with cotton, and people respond to dryness by planting more. So now the abandonment will go up too, so that doesn't necessarily mean anything, but the planted acres will increase if that spreads that way. Now, actually it was all the way to here, and it did rain a lot recently, and it was snowing yesterday when I was north of Amarillo. And it's retreated a little bit, so we'll have to watch how this goes, but it will influence planting, just to let you know. But here's my take on the 2020 market. I'm going to assume 12 million planted. I'm going to assume average abandonment, which is like 15%. So if we harvest 85% of 12 million acres, that'll give us that, over 10 harvested. I'm picking an 800-pound national yield, which is sort of more or less an average yield. We're carrying in over 4 million acres or 4 million bales from the previous, over 5 million, excuse me, from the previous year. We have a 17 million bale crop. That gives us 22.5 million bale supply, which is, you know, a healthy supply of cotton. We're still using 3 million bales over here in this part of the world to spin yarn and ship the yarn overseas to the Dominican Republic or wherever we send it. There's what I'm guessing that, you know, we don't have low prices to stimulate historically high export sales. I'm hoping this isn't too high, but I'm going to assume that we export 15.5 million. If you do all that math, you wind up with somewhere around 4 million of ending stocks. Okay, 4 million of ending stocks. Now the ending stocks number is what's important. That's how we predict prices. You know, when ending stocks increase, we generally have weaker prices, and vice versa. We make the comparisons to the previous years. So 4 million compared to these years is kind of, you know, right on the edge. It's right on the edge of either treading water, basically the same as the previous years, within 1 million bales of the previous years. I call that treading water. Or it could get tighter. I mean, everything here could change easy. This whole outlook could change 1.5 million bales to the upside or the downside. So it could basically be treading water with those years, or it could be tightening compared to those years. And that difference matters. I'm going to wind up with this slide here. The difference matters because the price behavior is different in years when we're tightening versus years where we're treading water. So in years where we're tightening compared to the previous year, that's all those years. If you average December futures prices in years that we're tightening compared to the previous year, that'll give you a seasonal pattern, price pattern, that follows this level here. You get your normal rally in the springtime. It peaks a little bit later in the year, in the summer, in July. And then there's a surprising amount of price strength later in the year. If you extrapolate that on top of December 20, you could see futures rising into the mid-70s. Maybe one of these little hedge fund rallies up into the upper 70s, but basically going up into the mid to upper 70s and then kind of hanging in there. Compared to years where we're just treading water, which is the average of those years, that pattern, you get your springtime rally, but then you get also your normal, that's interesting. You get your normal seasonal price decline, your normal harvest time price pressure. So I don't know which of these patterns is going to extrapolate off of, but I think the opportunity is clearly there for prices to at least get to the mid-70s with a few shots to the upper 70s. That was mine, thank you, to tell me to shut up. So that's good because I'm done, except I can't advance any further. Well, my contact info is on the last thing, but I'll still be around. So anyhow, that's what I had. I think the opportunity will be there for quick, brief, profitable prices, and so that sort of behooves you to have a marketing plan that's quick and nimble. So, yes, sir.
Are your slides online anywhere that we can look, or I might show some of this?
Yes, all the graphs are available on a website. If you Google cottonmarketing.tmu.edu, or actually if you just Google Cotton Marketing John Robinson, it'll take you to my website. And the website's kind of built like an encyclopedia, but it's got little sub-articles and sub-pages, and all these charts are updated usually on Fridays when I'm not traveling. Okay, well, it's a pleasure to be here in Georgia. Yes, sir.
Do you really think the 16.5
export numbers realistic?
No, actually no, because I don't think we'll physically ship it. We may not cancel those sales. Hope not. I hope if the phase one agreement means anything, I hope it means that they won't get canceled. But there's some question whether we can ship that much. It would be a historically high level of shipping to actually achieve the 16.5. And every opinion I've heard from people is that no, we probably won't make that target. So there'll probably be more carryout. Now hopefully that'll beef the export number in the next year, so it will eventually get shipped. It's a good question. All right, well, thanks again.